But you're usually not going to be able to own a home around here without the help of some good financing. So I'm asking Howard Yee from the credit union to come and just speak a little bit about the financing and some of the dynamics of it.
I'm glad everybody was able to join in today. And what I want to do is actually just kind of give you guys some tips on preparing yourself and getting ready to buy a home. You know, you guys are all ending a milestone of graduating from college and moving on to the next stage in life. And I know that each and every one of you guys, at one point in your life, you're going to want to buy a house. And you guys would be considered a first-time home buyer. And some of the things that you guys want to just kind of prepare yourself for is your credit. Credit has a lot to do with the type of loans you'll get, the type of pricing of the loan, the interest rates that you'll receive. So some of the people that may be fortunate that didn't have to take student loans, the really main focus is try to reduce your debt load as much as you possibly can. This will actually allow you to have more purchasing power. A key part of the credit is actually keeping your credit up to date. So whatever you try to do, be on time with your payments. Because everything now is actually credit score driven. So if you guys have heard the term FICO score, anybody who has credit cards, you'll periodically see, hey, your FICO score is 800 or 750. When you do a mortgage, the mortgage actually runs a tri-merge credit. And what a tri-merge credit is they use 3 different reporting bureaus. One is Experian, Equifax, and TransUnion. And what they do is each one of these credit reporting bureaus will give you a credit score based upon how well you've paid on your credit, how much credit you have outstanding, what your balances are versus what your credit limits are. What determines the score is, like I said, the payment history, the balances versus limits, the amount of inquiries. So you want to try to minimize how many credit cards you actually have. The rule of thumb is try to have at least 3 trade lines open. The more credit you have out and the more money you spend, the likelihood that your credit score could be decreased because you have more out. Back to credit is when you have student loans. If you have multiple student loans, if there's any way that you guys can ever combine the student loans by consolidating to reduce that monthly payment, that actually helps quite a bit. Now, qualifying for a loan, you know, as you guys graduate and you guys are going to enter the working force, the way banks will actually qualify you is they will take what your monthly income is, or your monthly salary, and we will use actually 40% of your monthly salary to qualify for a loan. Now that 40% will contain your principal and interest payment on the mortgage, your taxes, your insurance, and all the other expenses that you have, like possible auto payments, student loan payments, credit card payments, and the maximum that most banks will want to lend is 40% of whatever you make. That also determines how much money you can actually borrow too. So, you know, the more you have out, the lesser borrowing power you're going to have. Income that most banks will use, again, when you have a salary, it's pretty much take your yearly salary, divide by 12, and that's what your monthly gross income is going to be. Some of you guys will be out there in the sales force where you'll make commissions, you'll make bonuses. Most lenders will use bonuses and commissions as part of an income, but they like to see a 2-year history of that. So if you just start with Google, you guys graduate and you start with Google, and it's very common for Google to say, hey, you're going to get 15% of your salary as a target bonus. You'll get stocks, but you've only been with the company 3 months. Well, for a lender, the guaranteed salary is your salary, not the bonus yet, because you haven't proven that you've received that bonus for the last 2 years. And that's what they want to see, is just the history of that, to use as extra qualifying. A lot of these companies actually give you RSUs, restricted stocks, just like Facebook and Google. A lot of them will give you to entice you to join the company, and we're going to say, hey, we're going to give you all this stock, but this stock is not going to be available to you for another 6 months down the line or a year down the line. You'll see it on your W-2s at the year end that, yes, they've given you all this stock, and they'll say that, yes, you've earned this much money, but if you haven't sold this stock and it's not available to sell, it's actually not really treated as income yet. So a lot of you guys will come back and say, hey, I've got RSUs, can I use this as income? Most of the time, we try not using that. Case by case, depending on what it is and how quickly or how soon it's ready to be sold, we can use it. But for the most part, no. The down payment on a loan. So another key factor on purchasing a home is really your down payment, and that's really saving money for that down. Ultimately, if you can have 20% of the purchase price, that ultimately will give you the best cost on the loan, the best rates, in combination with a good credit score. Nowadays, this market, especially on this side of the bay, 20% is a lot of money. $1 million, that's a $200,000 down. That's a lot of money to save. There's a lot of lenders out there, and as for us as well, we have different types of programs where you can put 10% down, even as low as 5% down. There's also the option that if you have parents that are willing to give you a gift, that also helps a lot. 20% gives you the best of the best. 10% gives you a good rate. It gives you an option of getting into the loan, but it is a little bit more costly. When you do put 10% down, there is an item called PMI, which is called private mortgage insurance. What that does is, private mortgage insurance is actually a benefit to the lender and not to you as the buyers. Because what it does is, it's an insurance policy that you will pay on a monthly basis to protect us in the event that you default on a loan. If you have any options, try to avoid PMI, just because it's going to be more costly for you. That's where it comes into different types of loan programs, where you can get into programs where they're called like an 80-10-10, where the lender will actually offer you a first loan of 80%. The lender will also give you a second loan of 10%. You still come up with 10%, and there's no PMI insurance. You'll have the benefit of both loans for the interest and the monthly payments. When you're purchasing a home, every lender is going to ask you to show reserves. So even though you may have saved $200,000 and that's all the money that you have, but you need to put $200,000 down, you really have to have a little bit more after, because once you put all your money down, the bank wants to see that you do have money in reserves. Just in the event that, say, you lose your job, that the bank knows that you do have some money that you can make payments until you find another job. And the reserve amounts can vary from 6 months all the way up to 18 months, depending on which bank you go to, what lenders, what the requirements are going to be. A lot of you might also have options of out-of-the-country funds. So the fortunate ones that are able to have that, all lenders will accept those funds. You just have to prove where you're getting this money from. So if you have money in China and your parents are saying, hey, I'm going to give you $100,000, you just have to show that, yes, it came from this account into your account. Now, a little trick behind that is, if you know you're going to buy a home and you know you're probably going to find a home in the next 3 to 6 months, and your parents are saying, yes, this is the money I'm going to give you, as long as that money has been in your bank account for at least 60 days, because when we ask you to show proof of funds and the bank statements don't show a large deposit, the banks are automatically consider that's your funds, and they don't ask you where you get the money from.